Well, everyone, welcome back to, kind of these industry discussions. We'll wait another minute or so to allow other students to kind of log in, and then I'll kind of turn it over to the PNC team. Great. Alrighty, so we'll kind of go ahead and get started. Welcome everybody. First off, I want to thank Ryan and Larry and Lisa and the rest of the PNC team for making the time to kind of present and share with some of their industry knowledge with us. This is after, I guess, quote unquote, normal business hours. So really do appreciate you guys, spending time to kind of plan and deliver, the presentation, kind of give a much needed introduction to corporate banking. Just for the students kind of on the call before we get going, these presentations are really designed and really meant, not only for you guys to be able to learn a little bit more about an industry, and a company in general, but also to develop your personal networks as well and professional networks. So if any time during these, this conversation, you guys have a question on a topic, please feel free to, ask away. There's a chat box on the bottom. You guys can enter, kind of your chat and get a question out there, or you can simply unmute yourself and ask away as well. Again, this is a learning presentation for all of us. And Ryan and the PNC team, really appreciate you guys being here. And I'll kind of turn it over to you.
Thanks, Brad. Yeah. I guess first and foremost, probably congrats to all the folks that have participated in the ACG Cup. I kind of think back to my experience in undergrad, and I think some of those competitions were just a great experience regardless of the outcome. I remember talking about a lot of them during interview process, or future employment opportunities came from them. So congrats to everyone. I think a lot of the putting together a deliverable and working with a team goes a long way, and obviously you're kind of interested in bettering yourselves, and so that will show well obviously in the job hunt. So I think starting off, Ryan Bennett, I'm a relationship manager for PNC's corporate and institutional bank here in Portland, Oregon. I joined PNC June 1st of 2020 with its expansion effort out into the Pacific Northwest. And Alyssa will talk a little bit more about kind of the strategy there. Prior to joining PNC, I spent almost 10 years with JP Morgan Chase. And prior to that, I went to University of Oregon. So been in Oregon most of my life. Spent a couple years working in Chicago for a desk that worked on private equity and M&A transactions. Most of that, I think, is similar to the case study that you guys are working on. That's most of my background. I think before letting Alyssa and Larry get into theirs, we'd ask that feel free to interrupt us. We're all pretty casual on the phone. We'd love your questions. I think, like Brad said, this hour or however long we're on is your time, and whatever you guys can all get out of it is much better in our perspective than us kind of reading off a slide. So with that, maybe Alyssa, you want to introduce yourself?
Yeah, thanks, Ryan. And folks, very good to meet you guys all, and congrats. I echo Ryan's comments regarding your involvement here. It's great to be meeting with you, and congrats on making it this far. My name is Alyssa King. I've been with PNC just a few months, but my banking career has been in the Pacific Northwest for the most part for the past 15 years. I started my career at Bank of America, and most recently was at JP Morgan for 3 years as a relationship manager. And super excited to tell you a little bit about PNC and give you an introduction to corporate banking. I will turn it over to Larry, our other PNC colleague, part of this group.
Yeah. Thanks, Alyssa. So good to meet all of you, and like my colleagues, congrats for all the work that you put in. So Larry Jackson, I am the credit product specialist for the Pacific Northwest, and so what that means is really delivering the credit product to our prospects and clients. So very derivative title there. My background, graduated undergrad, spent 1 year with Comerica Bank in Michigan, moved to Charlotte, North Carolina, and was part of RBC in the early days, and then was part of the PNC acquisition of RBC in 2012, and kind of crossed the bridge there. Took a short stint in 2015 away from the bank and did some nonprofit work. And then in late 2019, found a seat back and kind of joined back at a time when the expansion west was going very successfully. And so had the opportunity to have some conversations early last year, just really about the growth and what we were anticipating to happen in the Portland, Seattle, so Washington, Oregon markets. And what was interesting for me is that having been in Charlotte when PNC acquired RBC, I got to see kind of what it meant to be an expansion market and to jump through all the opportunities and things that had kind of arisen. And so the concept or the idea of going and being part of that expansion again was very exciting. And so it's been great. Conversations progressed quickly, and we moved our whole clan out here at the end of July. So we ventured in. We're up in Duval. And very excited to be in the Pacific Northwest. Excited to be part of the team with Ryan and Alyssa, and excited to kind of share some thoughts here. But as Ryan stated, like, these conversations and some of the dialogue will be a lot better with questions and participation and stuff. So please jump in, raise your hand, ask questions, even if it's unrelated. We love to have the dialogue and just kind of talk about our backgrounds and kind of how we have arrived here. And yeah, hopefully it'll be a helpful situation, helpful conversation.
Thanks, Larry. Alyssa, I thought I'd maybe start on this, or was this okay for?
Yeah, perfect, Ryan. Thank you. So just to give you an overview of PNC. So PNC Bank has been around for more than 160 years. We have mature markets as well as new expansion markets, as you've heard from Larry and Ryan. And as you can see, our headquarters is Pittsburgh, but we have expanded westward, and Washington and Oregon have been new markets from an organic growth standpoint. But PNC's value proposition, as you can see below, is that we have a local delivery approach, as in the bankers and the product partners are really focused on serving clients within our markets. So while Ryan sits in Portland, I sit in Seattle and cover the Washington market. Our value proposition is that we are focused on the relationships that we build in our communities, and have full capabilities when it comes to corporate banking to really service our clients, also in international markets as well. As you can see our footprint. I think we can probably skip to the next page, Ryan. So while PNC has done an amazing job of growing organically and have expanded into the West region, we also recently made an announcement that we will be acquiring BBVA's U.S. business. And so what that does for the bank is put us in the top 5 bank in terms of presence and size. And as far as the assets and loans, we'd be number 5 behind some of the more recognized brands. But as mentioned, on the East Coast, PNC is been around a long time and has been a very strong brand. And we just hope to replicate that as we move westward. So that's exciting, because I think what that brings us is a full set of capabilities and a national footprint, with also a very differentiated approach to market. I think you guys are probably familiar with the banks that some of us have also been with, Bank of America, JP Morgan, and others as well. But what our value proposition again is that we're kind of bringing the regional banks high touch and great service with strong capabilities that you'll have with some of the larger banks. So with that, I think we could probably skip to the next page. Perfect. So I'm not sure how familiar you are with corporate banking. When I joined 15 years ago as an analyst, I knew that banks were a place where, you make deposits and sometimes you get loans, and that was really more on the personal side. And, PNC has an expansive retail branch system as well, which we're again building out on the West Coast. But when it comes to corporate banking, you can kind of think that in similar way to just larger companies, right? So, as far as our capabilities, as it's outlined here, we have capital markets, financing solutions, and treasury management and cash management services, as well as our ability to, pull in various partners if it, deals with wealth management of C-suite executives or founders and owners of companies, as well as helping companies think through how they're going to help their employees manage their, retirement funds, 401k, and workplace banking, and those types of services. So again, it's a full set of capabilities that PNC extends to companies for them to manage the company's, cash in, cash out, loans, that sort of stuff, as well as addressing the needs of the employees as well as individuals within those companies.
So I think I'll pause there and see if anyone has any questions before kind of move into the next section.
I'd like to know just kind of how did your guys' backgrounds in the banking industry then come in to help from, the bigger corporations like JP Morgan, I've heard a couple of times. What did you guys accomplish there, or what information did you grasp there that you found was really helpful to bring into PNC?
Yeah, and I think, that's a great question. I think all of the banks have a corporate banking practice. And so wherever you start, you will, learn the basic fundamentals of corporate banking and the services they provide. I think PNC was a unique opportunity for, the team here because it was an opportunity to grow in a new market. But as far as the learnings, it would be probably similar across the different firms. PNC also has very experienced bankers, and had I started at PNC maybe on the East Coast before they expanded westward, I probably would have learned the same types of processes and how we look at extending credit to companies or helping manage cash flow. Cash inflows and outflows to, pay suppliers and collect from customers and all of those things. But I would say it would be pretty much similar across the firms. I don't know, Ryan and Larry, if you have any other insight.
No, I think that's a really good question, Shauna. And I think what I'd maybe add on top of echoing everything Alyssa said was historically, I think a lot of corporate bankers are credit trained, and that's where a lot of banking resources are put into some of the junior talent. For example, when I started with JP Morgan, there was a 10-week training program right when you started that they put everybody in Chicago from all over the country. They put you up in housing for 10 weeks, and they went from kind of accounting and finance 101 in the first 4 to 5 weeks to then having different case studies that you worked on individually as well as with teams and presented to people, and that was kind of the entrance for you to get into your credit analyst role, which is what I started at. And I think from a bank's perspective, they want the Larrys, the Alyssas running around in the market selling product that isn't going to get the bank in trouble. And so from that landscape, I think making sure people feel comfortable with the bank's credit appetite is a pretty important skill. I don't know if there's too many differences, quite honestly, between, like to Alyssa's point, between a lot of the larger firms and even some of the more regional firms, between how they start to train folks at an early age. I think there's a lot of different credit training programs or rotational programs that I think maybe are becoming more apparent, so that people at an earlier age learn not just the credit, but also treasury background or service or other items that become important in our day-to-day jobs. But I don't know, Shauna, did that help kind of answer your question?
100%. Thank you so much.
Yeah.
I think what I would add to that is just it is that credit. I mean, just second, the credit training piece that you get and you learn, and the deal interactions that you get at each institution vary. There's different, and depending on regional location and geography and everything else, your just the deals and stuff that you get to see change, and the internal conversations around those deals change. And so we all kind of bring all that deal history with us each step of the way, and kind of learn and build on that throughout our careers.
So just to kind of add to that, it kind of sounds like really, your credit training is really kind of the foundation for your knowledge base. And then as you progress in your career, now you're branching off and you're learning some of these other product groups and some of these, how to sell and intricacies of some of those other product groups. Ryan, I know earlier you mentioned that your role with the bank is the relationship manager. Can you kind of talk maybe a little bit about, how do you, number one, get the relationship with the client, but then as the client kind of evolves, bring in Lair, bring Alyssa, bring in your product partners to kind of make sure that you're really servicing their needs?
Yeah, no, happy to, Brad. And I think sometimes we use vernacular that maybe isn't, and I should have done this. A relationship manager for bank is basically a sales role, and you can be called a bunch of different things. It's business development executive. There's other, I'm sure, terms, but basically I'm in sales for PNC. The relationship manager aspect is truly our sales process is building relationships with folks. And if you can imagine, if I'm at our corporate and institutional bank where I sit, typically covers $50 million revenue companies and up. And if you can imagine trying to ask for a piece of business from a CFO or CEO or an owner of that type of business, they're not going to just kind of give it to anybody that walks in off the street and asks. You need to get to know their business. You need to understand who they are individually, what from an ownership perspective, what are their goals, from a CEO or CFO perspective, how are they trying to accomplish those goals, and really get a better understanding holistically of the company before you can then start probably the sales process, if that makes sense. And so I think probably everybody on the line with me from PNC has a different style of how they go to market and how they present themselves. But for me, the way that I think I've learned it is, and the way I'm still probably learning it, is just how to develop kind of that relationship with the decision makers and figure out what they're most interested in, and then figure out kind of the right solution from the banking side that makes the most sense. I don't know if Larry or Alyssa, you have anything else to add there?
Yeah, no, that's well put, Ryan. And I would say, banking profession, it's there's an art to it, there's a science to it. So when we refer to, fundamental credit knowledge, that's kind of the technical aspect of banking, right? As you're thinking about lending your balance sheet to companies, if you want to, participate in a $100 million, $200 million facility, why is a bank going to be comfortable in lending that kind of amount of money? And so really understanding the risks associated with extending credit, as well as making sure that you're building a relationship with the company and the decision makers to position your bank to be the one that they want to work with. I think, as you can see, there's a very broad set of skill sets that are needed to be successful. I think that the other aspect of kind of what we do is also working closely with their product partners. So as Ryan said, I also work as a relationship manager. A lot of people like to refer to that role as a quarterback and the face of the bank. And so as we are identifying companies that we want to build relationship with and pursue an opportunity on, we're constantly leading a team of product partners and experts, within PNC to make sure that we're delivering good thought leadership and making a case for why we should be, their banking partner. So that's another, aspect of what we do.
Yeah, and if we kind of maybe moving gears here, or switching gears here, the slide that I have up, I guess, was I kind of, Shauna's question kind of preempted me to move to this. Kind of back as I think about entering the workforce and where I was kind of deciding on what career path to choose. I don't think a lot of folks, or at least at the time, I didn't know what corporate banking was or commercial banking. And I think Larry and Alyssa might agree with that too, as they were coming out of school. So hopefully some of today, we can kind of maybe give you a bit more of the day-to-day life of what we do. A lot of my friends went into investment banking or to private equity, corporate finance, or they did something, accounting, consulting, they did something else, but there wasn't a lot of talk about corporate banking. I think one of the things that, I've found that has been most enjoyable for me is, Alyssa mentioned kind of the model, and I think a lot of banks will do this, is they like to go with a local person. So, I grew up in Portland. I went to school in Eugene, came back and started my career here, and I started trying to cover businesses and management teams that may have been right next to the high school I attended, and I had never knew what type of product or business they were what they were doing there. But come to find out later that it's a really cool thing. They've got it's a third generation family that produces some sort of widget that has made a lot of money and set the family up for a long time. And it's just kind of cool to see those stories. And so getting the ability to meet with those individuals or those management teams at an early stage. I remember being relatively young, 22, 23 years old, and going and being at the table with CFOs or CEOs and discussing what their 1 year, 3 year, 5 year plan is for their business. That I think is something that's a little bit unique to some of the rest of maybe my friends or other colleagues that took positions elsewhere. And we in corporate banking, we do work on some very large companies. We might not be on Wall Street and doing a really large equity IPO for Peloton, for example. But we do get to kind of meet with decision makers, and from think kind of going back to my undergrad days, it was enticing to me to kind of start working right with CFOs and CEOs at an early level. I don't know if Larry or Alyssa, you have any other comments on that, if you think about kind of starting your path into kind of the role that you're in today.
Yeah, I think for me, it was that exact thing. Like, I come out of undergrad, and I'd done an internship in marketing, had no drive or direction towards banking, and it was an opportunity that presented itself, and was thankful to join an organization that had a credit training program, and basically spent, like, I think you had 10 weeks, I think ours was 8 weeks, and they basically taught you what it meant to analyze and then lead to underwriting a deal. And it was through those 8 weeks, it's like, okay, now there's a tangible skill that I've learned that's going to kind of carry forward. And I was telling Ryan this earlier today, like, I was thankful that it was something that I liked and it was fun, and we could jump right in and start to have the dialogue and the conversations. And you got go out on calls at a very early part of your career, and lots of times we were sitting on the outside of the table and just listening. But even that, hearing the dialogues, hearing the conversations from large scale companies to startup companies to all the different varieties of industries and stuff. And so it's just a fairly unique opportunity to see, to dip your toes into the financial industry, see what you like, what you don't like, and the paths obviously can take you in different ways. Not to steal Alyssa's thunder, but I know Ryan and Alyssa both went through the training, went through the kind of the underwriting set, and then now have stepped out into the RM world. My path went from kind of credit underwriting into a manager role, and then now as we kind of evolved what our product offering is at PNC, into what we define as our credit products role. And so still get to be client facing and join arm in arm with Ryan and Alyssa in delivering those conversations with our clients and prospects. But those baseline skills that we all learned in those early weeks and then refined over the years really provide so many different opportunities within financial services, but also more broadly to just a skill set that correlates to basically any business and in the financial shop of any business, or gives you insight into entrepreneurship and the challenges and things that folks face when they've stepped out in that way. And so it's every day is a learning process. Like every day we learn something new, we see new deals, and it just changes and refines kind of our skill set and stuff. So it is a great launching point.
Mm-hmm. Yeah, I definitely agree with that, Larry. I would say it's just been a very rewarding career for me. And I've seen a lot of different industries where, you could, be either on a finance team within a company, but it doesn't really give you the opportunity to, again, as Ryan said, connect with, the C-suite executives or founders and entrepreneurs of these companies, as well as allow you to see various different industries. I think, we cover general industries, meaning we can be working on a company, and next day it could be a manufacturing facility or manufacturing firm or food and beverage company. So that variety of industries and companies and deals that we're looking at, as well as the various different impressive C-suite executives and individuals that we deal with on a day-to-day basis, I think is what makes this job very rewarding and fulfilling.
I know we kind of have talked quite a bit for the last few minutes. Is there any questions out there? Okay, no worries. I think part of this slide here too is I think we were trying to give everybody on the Zoom a little bit of a flavor for some of the financing solutions that are out there, and then I can drill in, and Larry will get in more depth later on some of the actual products that maybe you find most often with corporate banking. But this is I think what we're just trying to show here is the different maybe steps that a company might take from startup to a mature company. I think where typically in the corporate banking environment we will focus on is the early growth to kind of that mature. The startup nature is we're able to have good conversations, strategic conversations, but from a financing perspective, those companies can be more difficult. I think you kind of see on the left there's a lot more of the equity or insider financing that fund those businesses, and at a very, very high level, typically a kind of corporate bank likes to see two sources of repayment for any sort of debt it provides. One of those is cash flow. So a startup may or may not have cash flow yet, depending on where they're at. They could be just in product development or pre-revenue. And then the second thing that banks typically want to see is collateral, right? So again, startup may or may not have those things. So where we typically tend to focus on the financing side is a little bit later on. And typically what we'll offer are single bank loans. We can get into syndicated debt, and we have partners that then kind of look at the institutional debt or private placements. And then on the mature side, we also have, the public bonds, public equity. We've got, kind of some, experts that would sit and help with companies looking to do that as well. I don't know if, again, I don't want to talk over any questions. Okay. If I kind of think about the case study that you all were working on with Go Faster, I believe the three kind of different options that I think you all were evaluating were, should the company expand its manufacturing capabilities and try to grow that way, if I recall correctly? Should it look at it acquiring a different business, or should it potentially sell out to a private equity? And all three of those situations is where myself, Alyssa, and Larry could find ourselves talking to different businesses about. Typically, if you think about all three of those options, if you want to expand your manufacturing capability or improve it, maybe that's a new piece of equipment, maybe that's a updated ERP system, that could be a loan from a bank. If you're looking at going and buying a new business, obviously you're going to need capital to do that. And I think in the case study, the acquisition scenario, there was a certain amount, I think all of it was bank financed potentially. And then obviously if a private equity firm comes in and buys the company, the private equity firm may choose to finance some of that acquisition with debt. Now, what I thought was interesting from your guys' case study was that I think it was, if I recall, it was like a 4x leverage multiple at 8%. I think that would typically play in the leverage financing category, in the kind of second column there, where you're seeing second lien mezz or similar to maybe that, than where we typically play. Most of the loans that Larry, Alyssa, and I do are covered by assets and cash flow, like I mentioned, and we're on the less risky side of the kind of right side of the balance sheet, where we typically have pricing that's based off of a LIBOR floating rate, and it could be anywhere between 150 to 200 to 250 to 300-400 basis points, or 1 to 4% above LIBOR, but typically that doesn't reach the 8% that you guys were looking at. Now, in certain situations, that I guess loan pricing is acceptable or required to meet return hurdles. So at the end of the day, just like in your case study, we're looking at a risk return scenario as a bank, and we're trying to figure out the best way to solve for that. I won't say that bank loans are perfectly correlated to the underlying risk that we always take, but we try to make it as even as possible there. So yeah, I don't know if Larry, Alyssa, or if there's any questions, feel free to start that. But I don't know if Larry, Alyssa, you have any other comments about some of this slide.
Yeah, no, I think you did a great job, Ryan. I would say that, the spectrum of financing really, varies based on the stage of the life cycle a company is at, as well as, and that's really just a little bit correlated to the risk of the I guess the capital that will be extended. It's a risk return analysis that banks do, and I think that's where the pricing will vary, as well as the options of tapping into the various financing options. So yeah, and as far as corporate banking, the single bank and bank financing, we have a very low margin of error, that because if you think about it, we are not, venture capital or private equity type of shop where we can take high risk and expect high return. I think, we are our lending parameters and appetite is going to be, where we want to make sure that, if we are collecting deposits from our consumer retail, businesses, that we're really deploying that capital in a responsible fashion. And so definitely that risk analysis of lending to those companies become a high priority. And then furthermore, I would say there are a lot of other products and services that, we extend that would really help with that analysis. I know we're focused, primarily on the financing side, but there's, as mentioned, cash management, treasury services. Those are all additive in kind of that return reward analysis of the loans that we extend to clients.
You guys maybe talk about, as you're looking, at a client, you guys mentioned that you typically like two different sources of payment. One's cash flow, the second is kind of collateral. Could you dive, maybe a little bit deeper on that? Is all collateral, quote unquote, treated the same? What kind of collateral are you guys looking for? And then when you're looking at cash flows, how do you kind of de-risk, kind of forecasting cash flows and analyzing cash flows for some of these, not startup companies, but still like high growth companies, going forward?
Yeah, I don't know, Larry, you want to lead with that response?
Yeah, that's a great question. I think you step back to kind of banking 101, and this is something that again, I think myself at a point wouldn't have been able to answer it, but it's, when a bank makes a loan, what's the most important thing that can happen next, or happen over time? And I think my answer would have been like, well, they need to make money, they need to earn interest from that loan, they need to have a return based off of it. But the reality is, like, we have to be repaid, because in starting a new market in this area, like if Alyssa and I and Ryan, we make 10 loans and one of those loans has to be completely written off, that is a huge just a huge negative place to be able to start and to be able to recover from. And so we have to be super analytical as it relates to each individual loan, and ensuring that we're in a place to where we're highly confident that we can get a return. We're highly confident that we can, that it's what the company needs, and that it's something that's ultimately going to lead to a positive end game.
Yeah, and I think from a collateral perspective, and I know we might not go as deep, but there's different loan facilities that we'll set up. If we're looking at a revolving line of credit, and maybe think of this as like a personal credit card where you can spend up to a certain limit and then pay it back down and then spend up again. That is something that we deal with a lot. That is typically governed by accounts receivable, and it's governed by inventory. What typically happens, and this is going a bit in the weeds, is the sooner that the bank can get to true cash, the more that they will lend on it. So from an AR perspective, we know that we're just waiting on a company's customers to pay them before that turns into cash and they can repay our loan. With inventory, we're a couple more steps away, where the company has to either take the raw material, turn it into finished good, and then sell it, or if it's a finished good, they have to find that that next person to sell the inventory to. So we won't maybe get as aggressive on the inventory as we would on the AR. On something like a term loan, where it's maybe just one, similar to maybe like a mortgage, where you send one chunk of funds out, and somebody pays it back over time. We're looking at assets that will hold in value longer than not. So, from an equipment perspective, if we like a certain piece of equipment like a CNC machine, we think that will have value even if the company, like, let's say we lend on a piece of equipment and the company goes away tomorrow. We want to know that we can take that piece of equipment and sell it to another company similar to the one we lent to, and still, receive some sort of value back. It's part of the job when we think about collateral isn't always fun, because you start having to think in the worst case scenario, what kind of money can I get back from these assets? And in a worst case scenario, it typically means the company's no longer performing. Typically the inventory might be worth less than what you thought it was, because if the company's not performing, it probably means it can't sell it. And there could be other things that happen that make all the collateral that you have worth less. So it's that part of the job isn't always like the most, I guess, rosy and fun to think about, but that's typically how we think about it from a collateral perspective. And then on the cash flow side, historical results are always the best for us. It is like part of our job. From a high growth company perspective, is determining what's repeatable and what's not. And that can be very difficult. And I won't say that every bank has figured that out, or that, we can, hit and call the winners all the time, but trying to really determine, if you see something that's on a hockey stick, why is it, where are their customers coming from, is it repeatable or not, and determining that value. Jenny, I know you went on unmuted, so I want to make sure that you get to ask a question. Sorry.
Thank you. So it's interesting that you mentioned something in the case like the debt to EBITDA ratio. They will able to land the maximum of debt to EBITDA ratio of 3 or 4, and with the interest rate of 8 or 9. So I don't have a sense of like 8 or 9 are really, really high, or what's the typical interest rate for you guys? And it seems like it's pretty risky for your bank, but does any bank willing to do that?
Yes, I think if you go, Ryan, click back to the slide before this one. I think when you think about this in those that really fits kind of an early growth conversation. So LIBOR right now is I don't even know. I should have left my note up today that showed what the rate was today, but what are we, 35 basis points, 30 basis points, relatively low. And so most, like a typical borrower maybe in our space would be LIBOR plus 2%. So you're looking at a 2.25 to a 2.5 rate on a floating rate. I think the case study that y'all were looking at was from 2018. So just what's happened in the last 2 years has shifted rates substantially. But when we look at this tier and this early growth stage and stuff, when you think about equity, when we think about, I don't know if we had taken mezz financing and stuff off, there's different, we have the mezzanine debt and second lien debt, and the access to capital that early stage companies have, because traditionally when they get to our shop, when they get to the corporate banking shop, these are companies that have had some sustained earnings and growth. But some of the early stage companies maybe wouldn't be able to access, because we can't identify the progress forward and the insurability that revenues that a company has are going to sustain in the early days. Mm-hmm. They're leveraging other opportunities in other places, and so you have mezz financiers, which are will be in the 10 to 15% interest rate range. Okay. There are some senior lenders that would be other banks that may have specific products that would be tied to something along those lines. But generally speaking, for us, we would love to get a 8 or 9% return. But traditionally in our space, it's much smaller.
Okay, thank you.
And there are definitely banks, Jenny, that will be more aggressive in specific industries or for a specific company that it knows really well. I think we're probably speaking in generalities. One of the things that I saw a lot when I was working with private equity is that a lot of times they'll go and use non-bank lenders, and those non-bank lenders will, they'll go and fundraise from a bunch of different limited partners that provide money to the fund, and then they can go out and get more aggressive on companies that they like, but they'll charge closer to probably what you were seeing in the case study, all in at that 7-8%. And the way that they make money is they may be, their risk profile might be a little higher, and maybe they make mistakes here and there more often, but instead of, to Larry's point, getting 2.5% on the entire debt tranche, they're getting 6 or 7 throughout all levels of the debt tranche. And so even on that first level, or first turn of EBITDA, they're getting a 7% return versus a 2.5% return. And so there's a delta they're making on each tranche there that allows them to be more aggressive and a little bit maybe more creative than what a kind of senior bank would do.
Mhm. And I would add to that, Ryan, by saying that the senior debt market is highly regulated, and so that's part of the reason why kind of our lending appetite is within a certain parameter. As you can imagine, if we are using consumer deposits and are deploying that to lend, the OCC, the other government entities will want to make sure that we're responsible in redeploying that capital and are in a good position to be able to return those funds. As Ryan pointed out, if there are outfits that could have a different source of funding and they aren't as regulated, that's where they could get aggressive in terms of higher leverage profiles and more riskier deals and garner a higher return as a result.
Shauna, did you have a question?
I feel like you guys are kind of going in that direction and really piggybacking on it. I'm only going to direct this at you, Ryan, because you had brought it up, but kind of valuing collateral and taking a look at what is more secure or what looks more promised. Can you speak to how kind of you guys assess whether to be more aggressive or more conservative with that part of the analysis? So I feel like I struggle personally sometimes when we're doing some valuations like, oh yeah, if everything went wrong, and we're selling off all these assets and we're selling this machine, are we really going to get, that figure that we're looking at in the 50 million for selling this, or should we be more conservative and bring that down?
Larry, I don't know if you want to tackle that first.
Yeah, it's a very interesting one. So I think, again, when we get to the products here and we start to look at that, it becomes, we're matching loan facilities to the useful life of what it is. So a revolver tends to be tied to kind of AR and inventory, and then our term loans will be tied to equipment. When we think about valuations for collateral, if it is equipment, oftentimes we'll get appraisals that'll tell us what we believe the indicative return on the market will be should we have to foreclose on that piece of equipment. It feels like in most of the cases where I've been in positions to have to go that route, that we never quite get what that appraised amount is. There's been some surprises, some positive surprises in years past, but typically it seems like when you're forced in a situation to sell something, you never get quite the value that you think it is. I mean, it's much like anything in life. Like if I can hold out and wait for my price, then the time allows me to get more and earn more on that piece of equipment. If I've got to sell it tomorrow because I need the liquidity, then you're just subject to what the market is, and if you only have one bidder, it's going to be whatever they're going to provide. And so you have to be able to set up time, just like a housing market or selling real estate or anything else. You have to set up a time to where you have a window to solicit multiple bids. But in a fire sale situation, it's rare that you're going to get even what we've identified as appraised value.
Yeah, and I think some of this comes back to sometimes our jobs are more art than science, where the formulas will tell you to do a certain thing, but in reality, to win a deal or to provide the best thing you can for your customer, for them to succeed, you have to maybe stretch here and there. And so it's somewhat it can be difficult at times to know what the right answer is there. If you kind of take a look at maybe some of the current assets like inventory or accounts receivable, and you get into the bottom left of the screen here on an asset-based financing structure, that's where experts really take a look at the accounts receivable and the inventory. They'll do inventory appraisals. They'll do field exams, which are similar to almost an audit in some degree of checking books and records, as well as what type of AR is actually in the books and how much dilution there is there, or how much cross age and different things that would make some of the AR not as valuable as you'd expect it to be. But in doing all of that analysis up front, they will go ahead and they'll lend more money on a piece of receivable than a non-asset based structure would. So for example, if we know that one of our companies has AR from Nike, we know that's really strong AR Nike's going to pay, we'll probably lend 80% of that dollar. In an asset-based structure, they might get 85% or 90% because there's been more analysis done and the team there gets more comfortable. On the inventory side, there could be a situation where maybe a raw material is a commodity-based product, like steel, for example. You can also get more aggressive in lending what the fair market value is telling you that steel is worth, and just following a kind of like a stock chart almost on a dated, pricing commodities and checking that out and looking at what those are every day and updating how much you're willing to lend on that versus, kind of what we typically see in our structures is 50% of inventory is what we're willing to lend. So I don't know if that's helpful or not, Shauna, but it there's no real like good answer when it gets to kind of the where you need to stretch and how much do you stretch. I think it's always kind of you're based on your experience and the competitive influences on the deal and what else might be out there.
Well, that was perfect. I think what I'm hearing is that you're really tying what kind of loan you're giving to what kind of collateral you're using, and then using that to make your risk assessment. And that's perfect. Thank you guys so much.
Mm-hmm. Yeah, and I would just add real quick that the primary source of repayment is cash flow, right? So that's also weighed into that consideration. So if the cash flow is recurring and sound and you really have a good, reliable cash flow, then maybe you are able to get a little bit more relaxed on the collateral. But all of that analysis is in conjunction with both the primary source as well as the secondary source of repayment.
That's good.
So I know we're coming up on time here. We've got, I think, 8 minutes left, right, Brad? And I think we had this slide and a few others, but I think we'd all prefer maybe to answer a few more questions if anyone has them.
I think I'll ask Ryan and Alyssa a question just because I think this is interesting. So, coming from a great institution and driving it, and thinking through kind of your transition and opportunity at PNC, like what was the appeal for you to make that transition into this new opportunity in a brand new market, and made it enticing to be able to come to PNC for you?
Yeah, I'm happy to kind of answer first. I think one of the, I guess, kind of probably the most enticing thing to me was the entrepreneurial nature of PNC, right? I was the first hire in Portland, or in the Portland market, or the Oregon and Southwest Washington market for the bank, from the CNIB team. So for better, for worse, and hopefully better, I get to kind of make a stamp on what the PNC legacy is here and help build the brand. And so within I think a lot of you on the line will probably have opportunities to go into tech or other maybe faster pace industries. Banking's typically not considered fast growing or technology driven, although that's changing. To kind of get to form something new and do something unique doesn't always happen within banking. And so that was one of the things that obviously we've got the investment and the great capabilities of PNC behind us in the legacy markets and the systems and the product set and the large balance sheet. But then we're also kind of the ones here on the ground trying to form new relationships and generate business. And so it's kind of a unique opportunity, but that was probably the biggest thing for me when I was thinking about it.
Yeah, and that's same for me as well. I think, we're not directly building anything, but we're helping companies finance their growth and build their businesses. And so that's something that we kind of can relate to as we build our market here in the new markets that we have joined. I would also add that PNC is again has kind of the best of both worlds, as in we have all of the capabilities that the larger banks have, but we have a very differentiated approach to market. The regional banks are really great at building those relationships and making sure there's high touch to how we interact with our clients, and the consultative and educational approach to how we interact with our clients is something that is deeply appreciated, as well as the fact that PNC has been around for 160 years, more than 160 years, and has been a very steady capital provider and banking partner to many other great businesses.
What do you guys think as far, Ryan, that it is really exciting to be kind of the first ones, in here in the Northwest. It's a great opportunity. What do you think the biggest challenge that you're going to face as you guys look to kind of grow and continue forward?
It's a great question, and it's something I think we should, it's not just us, but I think all service providers to some degree will struggle with this. It's just letting kind of people know what the brand is about. And I think for PNC specifically, harder than a lot of other brands that may be in the market already, just because we don't have retail branches on every quarter like a US Bank or a Bank of America or a Wells Fargo does in our market, at least. So when we say PNC, there's a chance that some folks might say, and I wouldn't be surprised if, when I first told my family I was taking an opportunity with PNC, they had to look up what that was, right? Or they didn't know that it was a bank. So we have to kind of do a lot of work on the front end of letting people know that we are the fifth largest bank, or with the BBVA acquisition we'll be the fifth largest bank, and how we like to go to market and what maybe we can differentiate ourselves with compared to our competitors. And people are busy, right? And so it's for a lot of the folks we deal with, making a banking change isn't think about your personal life, right? Nobody wants to change their own personal accounts at any bank unless something really bad happens. And, it's the same thing on the company side, only even sometimes it's more complex because there's more payments and more accounts. And so, a CFO, a controller, anybody on the accounting or finance staff, they don't want to necessarily change banks if they don't need to. And so it's our job to figure out a value add that is so much better than what they're getting today to initiate and make that change possible, to build momentum internally to kind of start the process. But that's kind of but that's not, I guess, different than other of our competitors, but it's just a little bit harder when PNC might not be as well known in the market.
Yeah, when it's not kind of a quote unquote household brand
exactly
name yet. Well,
oh, go ahead. Ask your question.
I was just gonna say, we're kind of getting to the top of our time here. I just want to say thank the three of you guys for again taking the time to talk with us. Kind of thinking of like closing remarks that you guys might have. Is there any piece of advice that or anything that you wish that you would have known when you were just kind of starting out your banking career or starting out your career that you could kind of share with the group?
It's a good question. I don't know, Larry, you got anything?
Yeah, it is a really good question. I think for me, I think the most surprising thing, and so maybe this will be part of the way the answer shifts, is that my undergrad experience, which wasn't at a big university, little small liberal arts college in Southern Michigan. It was the reality that my undergrad prepared me for work life in being routine, being on schedule, being productive, and establish kind of the habits that you need as you enter the workforce. But the reality was that I think my actual classwork, there was very little of my classwork that actually pulled forward into my career in the early days. And so again, we spoke to the opportunities we had to be able to join the development programs and stuff and get to learn and adapt and very quickly kind of come to know what banking was, and then use that as kind of the launching point. And so I think that's the advice would be like, don't sell yourself short. The skills and stuff that you've established and that you've identified and that you're continuing to build and stuff will grow in your career. And so there can be that adversity on the front end of like, hey, I don't know how to do this, or I'm looking at this job and it shows like you need 1 to 3 years experience and I don't have that. Like what you've developed in your undergrad is the baseline skill set that you'll need to be successful. And in most cases, the skills you need to be successful in your role will be taught to you once you enter the force.
Great.
And I guess I would say, stay curious and don't think that you have a specific path that you want to pursue. I think the path that my career has taken me has exposed me to a lot of different areas within the banking world. And so staying curious and exploring all different, even if it's lateral moves, I think that's important because it really does kind of broaden your perspective. And then secondly, I would just say, really, really safeguard your personal brand. Whatever interactions you may have with, other contexts in the industry, always, follow up and be on time. And that's a personal brand that you can control and manage. And that will, be very well received and afford more opportunities down the road.
That's great advice.
Yeah, I think I would echo most or everything that both Alyssa and Larry said. One of the things maybe that maybe more specific, and I haven't at least knock on wood so far done this, but I think people a lot of times say don't burn bridges. The business community is small, especially in Portland, and I'm sure maybe to a lesser degree of Seattle, but if you do plan to stay within the Northwest, it seems like the longer I'm around, the more people know everybody. And so that, I heard that phrase, I guess, when I was coming out of undergrad, and I was like, okay, whatever. But I think it is, the more and more that I'm in the workforce, the more and more I see the different connections everyone makes. And so to Alyssa's point about personal brand, that will definitely serve you well if you build it right.
Yeah, great. No, I think those are all, great pieces of advice and words of wisdom. For everybody else, all the students on the call, again, just kind of reiterating the fact, the student, education and kind of student outcome is really at the heart of the ACG and really at the heart of the ACG Cup. Everybody that's been involved, whether that's your liaisons or coordinators or, even our sponsors, everybody's here for you. And make sure that you're truly leveraging that network. Don't be afraid to reach out to, these three on LinkedIn, shoot them a quick message. I'm sure, the three of them, if they're taking the time to meet with you after hours and kind of present, what they do, I'm more than happy to take a 20-minute call and answer, further answer questions and, kind of help you throughout your career as well. So thanks, Ryan. Thanks, Larry. Thanks, Alyssa. Thanks, PNC, for being here.